Most Forex traders blow their accounts because they don't understand the concepts of risks and money management. If you don't understand the concept of risks and money management, you won't survive in Forex trading. So stay to the end of this video, because by the end of this video, you're going to understand step by step how you can be able to manage your risks as a pro in Forex trading. You're going to understand step by step how you can build a bulletproof risk management strategy in Forex trading, which will ensure that you are able to make money at the end of the day. So what is risk management? Risk management is simple. Risk management is a quantitative analysis you put in place anytime you want to trade, so that you can only risk a particular percentage or a particular amount at a particular time. It also has to do with religious discipline. Remember, I'm talking about religious discipline. It also has to do with a rock solid discipline that you stick to that particular plan. So for example, if I'm trading Great Britain Pound USD today, or if I'm trading gold SAU USD, then I'm going to have it on my risk management plan to say, number one, maybe I'm going to go for a risk to reward of 1:1, or maybe I'm going to go for a risk to reward of 1:2. I'm only going to be risking 1% of my account. I'm only going to be risking this amount. So I already planned that before I get into the trade. I predefine my trades before I even execute. So risk management is part of you predefining your risks. You predefine your risks before you get into any trade, so that you don't get caught off guard, all right? Because I see situations where people get into trade and then they start asking people, where should I put my stop loss? Where should I put my take profit? Where should I trade my stop? Where should I exit the trade? If you find yourself still battling with those questions, then you shouldn't be trading at all. It's time for you to step back, understand the concept of risk and money management before you can be able to start trading. Money management is simple. Money management or risk management is what I just explained, how much your exposure, you're just managing your exposure in the market, while money management is actually the dollar amount you are ready to risk for that particular trade. So in a nutshell, or in a summary, that's the meaning of money and risk management when it comes to Forex trading. So I actually prepared something for you guys, which is going to help you to be able to build a solid risk management setup in Forex trading, or to incorporate any strategy you are using. I'm not telling you to throw your strategy over the fence, right? Any strategy you are using, just use these tips, just incorporate these tips in that strategy, and that strategy is going to be having a bulletproof risk management incorporated. So the number one rule on our list is what I call the number one rule of Forex trading. It's as simple as that. The number one rule of Forex trading, which is capital preservation. If you check someone like Warren Buffett, he has one of his favorite quotes that says, it's not how much you make when you are right, but how much you lose when you are wrong. All right, it's not how much you make when you're right, it's how much you lose when you wrong. So that is very, very important. If you don't have it as part of your risk management to control your exposure on a particular trade, to know that your goal is to be able to manage your capital. Your goal is to be able to preserve your capital. Your goal is to preserve that capital to live to trade for another day than to blow it on one trade. So capital preservation is very, very important. That's why I'm saying your number one goal is to stay in the game. Profits follow when risk is controlled. Profits will only follow when you are able to control your risk. Let's go to point number 2, which is the second. The second rule is just position sizing, and I call it the 2% rule. What does the 2% rule say? It says never risk more than 2% of your capital in one trade. In most cases, if you check something like Godlove University, all Godlove University students, we have it as a rule. You never risk more than 1% of your account in one trade. That's it. Some of them even go as low as 0.5%. You see, that's just to show us the importance of capital preservation. We don't just want to risk 100% on one trade trying to flip. You're going to blow that account. So capital preservation, then we have the 2% rule, which you never risk more than 2% of your account in one trade. And then, for example, if you have $100,000, there's no way you should ever risk more than $2,000 in that particular trade. Ideally, I'll go for 1%, which is $1,000, or ideally, I'll even go for 0.5%, which is $500 per trade. At that particular point in time, you have a level playing field, or you have a bigger room for failure. You have the greater span that you can give yourself room for failure. So in line with that, I'll have to say use a position size calculator to easily determine what percentage you're going to be risking in a particular trade. And that's why we're going to be jumping on my screen, where I'm going to be showing you the position size calculator I use on a daily basis, so that you can be able to know how to use that position size calculator. For example, let's just use a chart. I'm just going to open a quick chart right here, right? You can see we have this quick chart right here. And let's just say we've done our analysis, like what I'm seeing right here. Let's just say we've done our analysis and we want to enter this trade right here. Can you see this? Let's just say we want to enter right here and put our stop loss on maybe 10 pips and go for 20 pips. What am I going to do? You have a 100K profit account. How do you calculate so that you can only risk 2% of your account, or so that you can only risk 1% of your account? It's simple. First thing is you need to know the currency pair. You need to know where you're going to put in your stop loss, and then what will determine what risks you are exposed on that particular trade is the lot size you're going to be using. So how do you calculate that lot size? Just go to Lionheart Funding Program, position size calculator, and it's going to bring you to this page. Or you just go to Lionheart Funding Program, click on tools, and then on calculators. When you go on calculators, just click on position size in pips. Position size in pips, remember what was that currency pair again? It was AUD USD. AUD USD should be right down. Let's just check. AUD USD is right here. What's our account balance again? $100,000, and we're risking 1%. You just put it, we're risking 1%, and our stop loss is 10 pips. So what's the lot size? You click on calculate. You can see it shows 10 lot size. It means we're going to be using a 10 lot size on this trade. Meaning if the trade has to go against us or risk, we'll be losing $1,000. And if it goes in our favor, we'll be making 2 times this, since we'll be going for a risk to reward of 1:2. What if you wanted to risk 2%? You just change that, put 2, click on calculate, and it means we're going to be using a lot size of 20, and amount at the risk is $2,000. So that's the website on how you can easily be able to do what? You can easily be able to calculate your risk exposure so that you can respect the 2% rule. So everyone needs to be using this particular website. Now let's go to leverage. Is leverage your friend? So that's point number 3 on our list on how you can manage your risks. Talk about any other thing you like in Forex trading. If you're not talking about risk management, if you're not incorporating risk management, there is no way you're going to succeed in Forex trading. That's why I'll take this time to emphasize on this. Point number 3 is leverage. Is leverage your friend or your enemy? All right. Leverage is something I used to always call, it's like a two-sided sword. You know, one side is sharp, one side is not sharp. All right, a two-sided sword. And if you know how to use leverage, if you know what you're doing and know how to use leverage, you can make a lot of money within a shorter period of time. But if you don't instead know what you're doing and you're using leverage, you can instead blow your entire account in a shorter period of time. So that's what I'm saying. Leverage is like a two-sided sword. That's why high leverage is very dangerous for beginner Forex traders. Beginner Forex traders believe with high leverage, your broker is going to be lending you a lot of money or bigger capital for you to trade. Failing to understand that the downside is they're going to be leveraging on assets they don't have experience yet. So that's why I'm advising, if you're starting in Forex trading as a beginner, don't over leverage your account. Even if the broker is giving you a leverage of 1:20, 1:50, or 1:100, that's totally fine. Don't say you're going to go for 1:1000 just because you see other traders trading with that. Another point number 4 is my almighty risk to reward. I can't emphasize this a lot. Always aim for at least a 1:2 or a 1:3 risk to reward. So what is risk to reward? Risk to reward is the dollar amount you get for every dollar invested. It's the percentage you get for every percentage invested. For example, if I have 3 pence right here, right? Let me just use, this is a typical example of a risk to reward. I have 3 pence here. A risk to reward of 1:1 means I'm just risking 1 pen to go for 1 pen. As easy as that. A risk to reward of 1:2 means I'm risking 1 pen to go for 2 pence. Meaning if I lost that trade, I'll lose 1 pen. But if I win that trade, I'll win 2 pence. It's as easy as that. So it's the same thing in trading. A risk to reward of 1:1, meaning in terms of percentage, means you're risking 1% to go for 1%. Risk to reward of 1:2 means you're risking 2%, 1% to go for 2%. You see, risk to reward 1:2. 1:3 is the same. You're risking 1% to go for 3%. So ideally, I always advise You don't place a trade. It's the same thing we obey in Godlove University. In Godlove University, we never place a trade without having a risk to reward of at least 1:2. In that way, even if we have a win rate of 40%, we're still going to be making money at the end of the day. Let's do the math. If we have a win rate of 40% on a strategy that we are using a risk to reward of 1:2, means out of every 10 trades, we have just 4 of them that are right. Meaning someone who moved into our office, most of our trades are going to be right. 6 of them are wrong, and just 4 of them are right. Okay, those 6 that are wrong, we're risking 1%. We've lost 6% of our account. And those 4 that are right, we're making 2% for every one we win. So it's 2 times 4. We made 8% for that day, and we lose 2%. We made 8% for that day on the winners, and we lose 6% on the losers. So what was our net for the day? Our net for the day was plus 2%. And there are some days, as a day trader, there are some days you can take even up to 10 trades, meaning you are guaranteed that you make about 2% of your account in that day. Show me someone who can assure him or herself that he can make just 2% of his account every week, and I will show you a Forex multimillionaire. All right? Show me someone who can make just 2% of his account in a week, and I will show you guys a Forex multimillionaire. So the concept of risk to reward is something you should never sleep on. Make sure you practice on how you can incorporate it into your trading, and never press buy or sell on your computer if the risk to reward is not going to be at least 1:2. Don't be too optimistic. Don't go for 1:10. Just go for 1:2 and watch the magic happen. Next point on our list is stop loss and take profit. Non-negotiable. Stop loss and take profit. Some people trade based on hopes. They don't use stop loss. They don't use take profit. I'm just going to enter the market. Wherever the market goes, I'm going to close once I'm in profit. Guys, that's the first step of failure. That's the first red flag as a beginner Forex trader. As a Forex trader, or as a profitable Forex trader, number one, you need to predefine your risks. I don't know how long I can put that pre, all right? You need to predefine your risks before you can get into any trade. You already know, okay, if this trade doesn't go my way, what am I going to be losing on this trade? I'm going to be losing 1%. I'm going to be losing $1,000. If it goes my way, I'm going to be making $2,000. Am I comfortable to lose 1% on this trade? Am I comfortable to lose $1,000 on this trade? If the answer is no, then take a step back and reduce your risks until the answer is yes. You should place that trade and walk away in peace, all right? Place that trade and walk away in peace. Why? Because you have already predefined your risks. You have already told yourself that, okay, if this trade doesn't go my way, I'm very, very comfortable to let $1,000 go. I'm very, very comfortable to let 1% of my account go. And that day, even if you're trading with something like a prop firm with a daily drawdown of 5%, you know that, okay, I'm going to be placing a maximum of 5 trades. Meaning, even if those 5 trades don't go my way, I'll be comfortable to lose 5% on my account. Or maybe you can place 4 trades just to say, okay, if those 4 trades don't go my way, I'll be comfortable to lose 4% of that day so that I don't violate the 5% daily drawdown. So you can always play around this just to tell you guys the importance of always using a stop loss and a take profit. You've already predefined that, okay, this is how much I'm going. That's the mindset of a profitable Forex trader. That's a mindset of a winning Forex trader. And you guys already know how to place a stop loss and a take profit on your trade. Then another thing is the use of trailing stops. Most of the time, I'm going to do another video which is going to be coming up soon on why I don't use trailing stops anymore. Because in most cases, trailing stops have they're very common in the sense that they might remove you out of potential trades. They might remove you prematurely out of potential trades that would have hit your take profit. And again, they just help, they don't give you that peace of mind. In most cases, when I enter a trade, I want to know, okay, if it doesn't go my way, I'm fine. Hit my stop loss and I'll lose 1%. Hit my take profit and I'll make 2%. I don't want to break even or this. No. From my 10 years of experience, I tend not to be using a trailing stop anymore. I'm going to do a detailed video showing you guys examples and why I don't use trailing stops anymore. So predefine your risks, put your stop loss and your take profit, and you are good to go. Another one is managing drawdowns. All right, managing drawdown. This is very, very important. If you're trading, even in your private account, set a limit to say, okay, for this particular day, if I can lose up to this particular percentage of my account, I'm going to be stopping for that particular day. What does this do? It helps to prevent revenge trading. Have you ever seen a situation where you place a trade, it doesn't go your way, you get angry, and you want to revenge the market? Bro, no one can revenge the market. You're not going to come out alive. So stop trying to say, okay, I already lost this trade. I need to come back now with 2 lot size since I was using 1 lot size so that I can revenge and get my profit back. Even the little you have will be taken away from you. So stop trying to revenge trade in Forex trading, and also do what? And also manage your daily drawdowns. Have like 5%, you know, okay, if I can lose 5% of my account, that is it. It means it wasn't a good day. I'm going to come back tomorrow. Most of the time, the only thing I have is just a daily limit. I don't have daily target limit. If the market is going in my favor and I've made even 10%, I've made even 20%, I'm going to keep going. I'm going to keep going. But if I open my chart that day and I'm already down by 4%, I'm going to take a stop on that particular account and wait for the next day. So that's very, very important. Point number 7 on our list on how to build a rock solid risk management or to incorporate a solid risk management system in your strategy is diversification and correlation. Have you ever seen a situation where you place a trade on Great Britain Pound USD, place another one on Euro USD, and you find yourself, if the market is going against you, you find yourself losing a high percentage at the same time, or if the market is going in your favor, you find yourself making a lot of money at the same time. That's the power of correlation. It means they're positive correlated, all right? They're positive correlated. If one is going up, then the other one will be going up. If one is going down, the other one will be going down. So prevent those currency pairs. For example, if you are trading a currency pair like Great Britain Pound USD and Euro USD, you can see USD is the secondary or the quote currency. Meaning if one wants to go down, there's a high probability the other one will also be going down. So prevent yourself from trading correlated pairs. If I want to trade those two currencies at the same time, I'll instead prefer like Great Britain or Euro USD and USD JPY. You can see they are negatively correlated. Meaning if one is going up, one will be going down. So if today I do my analysis and I take a buy on this one, take a sell on this one, or I take buy on both, it means there's going to be a rare situation where they will all be deep out of profit, or they'll be deep in profit. They'll just be having a balance until this one hits my take profit or this one hits my take profit. So always trade currency pairs that are negatively correlated, and you can easily just know by knowing the currency in the currencies in the currency pair. For example, I can trade Great Britain Pound USD and USD JPY. I can trade XAU USD and USD CAD. I can trade CAD JPY and Great Britain Pound CAD. You can see CAD and Great Britain Pound CAD. One is having CAD as the first currency, and the other one is having CAD as what? As the secondary currency. I can trade NZD USD and Great Britain Pound NZD. Can you see? I can trade AUD USD and USD CAD. Great Britain Pound JPY and Euro Great Britain Pound. So all these pairs you can see, they all negatively correlated, and my drawdown is also going to be very, very managed. At that point in time, I'm also going to be doing what? Diversifying my risks. Don't put all your trades in one currency pair. All right, don't put all your trades in one currency pair. Learn how to diversify your risks. Point number 8 on our list on how to incorporate a solid risk management system in any strategy you are using is psychology and discipline. So your mindset determines your risk management success. Mindset is very, very important. Remember, everything I've just been talking about here those are all the components any person who is having a winning mindset should already have. All right. So mindset is just you sitting and knowing that, okay, I should already predefine my risks before getting into any trade. Trading is a game of probabilities. It's either I win or I lose. There's no system on earth that is having 100% accuracy. There's no holy grail. I need to be able to. So that's the mindset. That's the mindset of a trading or of a successful trade, profitable Forex trader, and stick to your plan. Avoid gambling and follow strict rules, or stick to your plan. Plan a trade and trade your plan. Plan a trade and trade your plan. Avoid gambling. Avoid trading out of hopes. Avoid FOMO, the fear of missing out. Avoid greed, thinking you never have a lot when it comes to trading. You believe you still, even when you've hit your take profit and the market keeps going in your favor, you sit on the sideline and you're already beating yourself up. You're already telling yourself, I would have been making this, I would have been making that. Avoid greed. You will never take everything out of the market. So take anything the market has to give you, hit your chest to say, I did a good job today. and walk away. So avoid FOMO, avoid greed. All of that is part of trading psychology that is going to make you a profitable Forex trader. Another thing is just having a realistic expectations. This is not going to take you a month, 2 or 3 months. It can take you up to a year to be a profitable Forex trader. But who cares? What if I take a year to learn a skills that is going to help me for the rest of my life? It took me 3 years to be profitable in the Forex market. But for the past 7 years I've been trading, I can make everything I lose throughout those 3 years of learning how to trade in 1 day or in 1 hour. That's the irony. So to conclude and make sure you have everything you need to incorporate a solid risk management system in your trading, number one is what I call the number one rule of Forex trading, which is capital preservation, which I mentioned of Warren Buffett. Number two is the second rule of trading, which is never risking more than 2% of your account. Number three is leverage. Is it your friend or an enemy? Leverage is a two-sided sword, which you need to understand. Number four, risk to reward, very, very important. You can't ignore this. Number five, stop loss or take profit is non-negotiable. You need to use it on all your trade. Manage drawdowns. Set a limit for your daily drawdown, and if you hit that limit, take a rest. That will also prevent you from over-leveraging your account. Number seven is diversify and correlation. Make sure never put all your trades in one currency pair and avoid trading correlated currency pairs like Great Britain Pound USD, XAU USD, USD CAD, USD JPY. Instead, trade currency pairs that are negatively correlated. Psychology and discipline. Make sure you have the mindset of a winning, profitable Forex trader. Make sure you build the trading psychology of a profitable Forex trader by avoiding stuff like fear, like greed, like FOMO. That is what is going to make you win in Forex trading. Make sure you start practicing this in every strategy you are using. I'm not saying any strategy you are using, just incorporate this aspect into it. And if you've gotten some value from this video, make sure you smash the thumb up on the video. And if you're watching my channel and you haven't subscribed, make sure you also smash that red subscribe button below to subscribe to the channel. Check the links below to use my recommended brokers. Make sure you're using my recommended brokers. Check out Perps Pro, which is the most viral and the most profitable Forex robot, which you can also use in your private and your Profirm account. You can also check out Godlove University, where in Godlove University, we're going to be trading live. We're going to practice most of these concepts live. So check out the link below to also join Godlove University. Join my free Telegram. I can see most of you guys are not in my free Telegram community. You're missing a lot. So make sure you also join my free Telegram community or my VIP Telegram community, and check the videos that are going to be coming at the end of the screen because they're all related to the same concept. Peace.